And yes, as we all heard, Mr. Bala Subramanian talk about, in his previous session, how mutual funds are creating waves in India's debt markets and emerging as a preferred alternative to banking channels for finance. Let's now hear it from Mrs. Usha Thorat, former Deputy Governor, RBI, on how we can further strengthen the potential growth of the Indian debt market. Ladies and gentlemen, please put your hands together and welcome Mrs. Usha Thorat, former Deputy Governor, RBI. Thank you very much for joining us here, madam. Please.
Yeah, good afternoon to everybody. Yeah, this has been quite adventurous considering I had a fall yesterday and I wasn't sure whether I'll be able to actually make it for this conference. Somehow anyway, it managed to come together. And like I say, I'm always well equipped, so I had all the things needed for dealing with such a situation, so I could come. Thank you. At the outset, let me thank Mr. Venkatesh for inviting me here today for this AMFI conference. I see Mr. Kurian is here, and we are old friends. We worked together in the same credit planning cell way back in 1978, I think it was, or before that. So you can imagine how long we go back. He was the first person who started AMFI, I remember that. Yes, the last point that we really sort of talked about was how the mutual fund industry seems to have taken real life of its own, and over the last couple of years it's really emerging very, very big asset class, and more retail savers are actually beginning to come through the mutual funds. And the debt mutual funds particularly seem to have really grown and become extremely important. While I was thinking about this conversation today, the topic, and for the last 3 years, I've been, in a way, after a long gap, got reconnected to the financial markets, and particularly the debt markets, as a chairperson of the Clearing Corporation of India Limited, and also the chairing the Financial Benchmarks of India Limited. Had a bit of an occasion to look at the debt markets a little more closely and understand what is driving these markets. So I've obviously looked at it from the point of view of a financial market infrastructure organization, because that is what really Clearing Corporation of India is. And the financial benchmarks, which is a very much new baby on the block, is an institution which was sort of recommended by the Vijay Bhaskar committee to have an independent, separately governed institution to administer benchmarks in the financial markets in India. After the LIBOR scam, this was something that globally regulators have tried to push countries into setting up independent benchmark administrators, because the LIBOR scam, it was felt, really reflected very badly on the financial system. And increasingly, there is a feeling, there is a need for benchmarks to be put out not on the basis of polling, which was really done in the LIBOR, but on the basis of traded, actual trades, either reported or actual trades. So that has been the effort in the Financial Benchmarks India Limited over the last 3 years. So the Clearing Corporation of India, of course, is an organization very familiar to all of you. And as mutual funds being one of the bigger users of the CBLO, perhaps its most popular product for mutual funds is the single organization in India that really clears and settles all transactions in the outright, repo, and the derivatives markets in forex and government securities. and offers guaranteed settlement in most of these products. And that's really the unique aspect of the Clearing Corporation of India. It acts as a central counterparty, and therefore it is able to offer much more efficiency and safety in terms of the netting that happens as a result of clearing and settlement. So the Clearing Corporation India has also got a separate subsidiary which offers a trading platform. So in that trading platform, all of these products which we are familiar with, the market repo or the CBLO or the outright government securities or even the forex spot and forwards, these are also traded, and now increasingly it is also offering derivative markets opportunities to trade and settle. The Financial Benchmarks India Limited, which is, like I said, is a much more recent organization, had started with actually offering, taking over the MIBOR. But the MIBOR, which is a kind of a polled product, now it is based on actual traded rates. So today the MIBOR, which is the overnight MIBOR, is a totally market-driven benchmark. Overnight benchmark is also available in the form of the market repo outright rate, which is another product which the Financial Benchmarks India, which is again an overnight benchmark, which can be used actually for developing the derivatives market. But as we know, the IRS today is really using MIBOR as a benchmark, but these are all benchmarks which could be used either for pricing or for valuation, or it can be used for any of the derivative products. Other benchmarks introduced by Financial Benchmarks India Limited are term money benchmarks, which are based either on treasury bills or on certificates of deposit, and it goes all the maturities up to 1 year. And also the overnight index swaps, which has become quite an active market, and from that you're able to derive a term money benchmark. So this is the kind of efforts that are being done, and it is really for the market participants to use these benchmarks to either find out, hedge their risks, or develop products, or use it for purposes of valuation. So that is the thing. What I thought is that, considering the background that one has had in the debt markets, I thought I'll initially flag a couple of issues which are critical for understanding the debt markets in India. And this I'm particularly making a point of it because the debt markets are quite different from the equity markets. And in the debt market, you have the government securities market and you have the corporate bond market. Of course, as a government securities market, you have the central government securities, you have the state government securities, you have the treasury bills. And in the shorter part of the yield curve, you have the CDs and the CPs, which are not really part of the securities market, but they are part of the money markets. And you also have repo in government securities, and you have the CBLO in government securities. And now I understand that the exchanges are developing a repo in corporate bonds on the exchanges, which will probably be as useful a product to all of you as you have been finding the CBLO in government securities. The most important, I would just like to flag certain factors which really affect the debt market. The first and foremost is the size of the fiscal deficit. The combined state government and central government fiscal deficit is a very important factor which affects the bond market or the debt markets in India. Because the size of the fiscal deficit implies that each year, new primary issuances, which are fresh primary issuances, really amount to a fairly significant amount. So every month, you have a series of new primary issuances in the market. So what's the impact of it on the debt market? The impact of it on the debt market is that, firstly, it does inhibit secondary market trading. Because when you have a new issuance coming, then usually the secondary market trading of the old benchmarks start diminishing. And you also have the impact of crowding out the corporate bond market. So the corporate bond market does get impacted because of the primary issuances, and of course it affects also the secondary issuances. Now, this is something that we have to accept as part of the macroeconomic scenario, but it is hoped that as the tax collections improve and as the GDP grows, so your fiscal deficit as a percentage of GDP would come down, and therefore the dominance of the primary market in both central government and state government debt is not going to be so overwhelming in terms of the bond market. So that's the first thing I'd like to flag. The second one I want to flag is that in India, the banks have a SLR requirement. Now, the SLR requirement, what does it really mean? It means there is a captive market for government securities. No doubt, market participants can bid in auctions and do a pricing. But the fact is that as their public liabilities increase, nearly 20% of this have to be invested in government securities. So it does skew the demand side of the market for debt in favor of government securities. There are similar requirements from the insurance regulators or the pension regulators, but it's more so in the case of the banks where the SLR is really much higher than what it would be internationally. Again, we hope that as the system, government deficits come down and as the system improves, our SLR requirements would come down to more global levels, and that would be a fair, level playing field between corporate bonds and between government securities. So that's another factor. The third factor is actually the entry of foreign investors. In the debt markets, the capital account management as a part of macroeconomic policy has favored the entrance of equity over debt. And this has been a part of the policy right from 1992. So whereas FIIs were allowed, FDI was allowed, the policy on external commercial borrowing or the policies on foreigners holding how much in rupee bonds, Government of India rupee bonds, or how much in corporate bonds, these have always been moderated or regulated or liberalized gradually. The reason for this is that in the debt markets, there is a certain amount of, what we call the carry, the difference you can get. And if you play the exchange markets, right, so probably you really get a huge inflow of foreign funds driven purely by the interest rate differentials. And even after taking into account inflation differentials, it sometimes proves to be an excellent asset class for global investors to invest in India. So this flood of foreign funds can completely distort our foreign exchange and money markets. And this has sort of shaped the policy on external account management as a part of the overall concerns with financial stability. So if you find policies on external commercial borrowing or masala bonds or any of these debt products, especially allowing new investors, overseas investors to come in, either into the cash market or into the derivative market, underlying, you have to recognize that there is a background of the macroeconomic management and of the capital account management, which will always impinge on this policy. So this is a kind of a factor which will remain as long as, I suppose, India's growth rates, interest rates, inflation rates are higher than what is prevalent globally, and unless we come down to more of the normal kind of thing. The fourth factor, I think, is that in case of investors and intermediary in the equity markets, you can, there are the exchanges, it's an order-driven system, it's all transparent. You can mark to market your listed securities every day. In the case of the debt market, it's not so. In the case of the government bond markets, there is because of the turnover having increased and because of the availability of valuation basis from the FIMDA, and even FIMDA, the Fixed Income Money Markets Dealers Association, do have to struggle to arrive at the valuation for the government bonds. If you look at the total number of government bonds in the market, there may be, say, 120 or so. Today, if you see 5 bonds, say, just in the month of May, accounted for about 80% of the market transactions. Say, 10 bonds may have accounted for something like 85%. And if you take the top 20 bonds, they accounted for 95% of the trades. So what these 20 bonds then become your basis for valuation across the yield curve. And I think valuation is the most critical aspect of a development of a market. And this has a tremendous relevance to the corporate bond market, because if we are able to really get a good way of valuing corporate bonds in a very transparent manner based on secondary market trades, then I think that itself will spur liquidity. The problem, however, is that there is a certain amount of, like I said, just 20 bonds, and 15 bonds are gone for 90% of trades. So these bonds are really extremely fungible in terms of credit quality. Whereas if you take the corporate bond market, even within the same rating, there could be huge variations. And it's not the case that today a corporate bond, in fact, I have some data on the corporate bond trading. The primary issuances of corporate bonds in 2010-11 was something like 8,89,000 crores. And today it's nearly 3 times that, the primary issuances, which is 27 lakh crores in the primary market, which means it's not a small market at all. And in the secondary market, what was around 600,000 crores in 2010-11 is now almost 13,000 crores. So there is a sort of a significant increase in both secondary market trading and in the primary issuances. So what's the problem? The problem is really the number of issuers. They're not repeated issuers in the market. You won't have the same bond trading every day or even every month. You might find a bond trading today, you might find it trading after a long time. Now that doesn't lend itself to good ways to value it. So the only way that we are valuing it is using the credit rating agencies. Either they use their own methodology for valuation, or we have the FIMDA valuation, which of course mutual funds do not use that. But there is this dichotomy in the market of different people, using different ways of valuing the same bonds. And I think this is a thing that needs to really be addressed. One of the things that the FIBIL has done, the financial benchmarks has done, is to take over the entire government bond valuation from FIMDA. So today, the valuation of government bonds is on the basis of the Oversight Committee of the Financial Benchmarks India Limited, having thoroughly looked at the methodology and in fact probably coming out with some new proposals as well for looking at the existing methodology for government bond valuation. Similar attempt, I feel, needs to be done for the corporate bond market, which gives every participant, whether it's an insurance company or whether it's a pension fund or whether it's a mutual fund or a bank or a primary dealer or a non-banking financial company, the same way in which corporate bonds can be valued. But it's tough. It is really tough, like I said, partly because of the size of each issuance, the fact that there's no liquidity, the fact that same ISIN number does not get traded so often. So one will have to, struggle with it and maybe come out with it. The fifth factor, and also the other thing happens in the debt markets, is that not all investors are mark-to-market investors. There are quite a few investors who are buy and hold to, maturity investors. And therefore, that also inhibits the trading in the government bonds or the corporate bond market, because to the extent that you are, buy and hold, obviously it inhibits trading. But there are good reasons for this kind of accounting treatment given the investor profile and their risk appetite. The fifth factor that I would say has inhibited the corporate bond market is, of course, the fact of the credit risk. I think this you must be spending a lot of time talking about, because most of the bonds, are still privately placed. And 45% of issuers are really financial institutions. So in a way, there's a further intermediation. You're not really sure about the credit quality of the ultimate borrower, because it's a borrower of the NBFC whom you're exposed to in a way. So financial institutions, and we will leave the sovereign REC, PFC out of this for a minute. And if you take them out, then you're left with the NBFC asset class, and then you're left with a whole lot of other manufacturing and trading. So you have this bunch of corporate bonds where I would say that even today, and this is a real shock to me, because I sometimes feel like Rip Van Winkle, you wake up after some time, you find things should have changed, but it's not changed. So it's opposite of Rip Van Winkle. You find that I would have assumed that by now we would have a really transparent primary issuance corporate bond reporting platform or, database. but I understand that we still are not there. Probably Prithvi Haldia is the only one which is still, doing that. But for the primary corporate bond market, when 95% is privately placed, at least we should have a single database, which probably AMFI or I don't know, maybe FIMDA, whoever, needs to really have. I understand CCIL is providing something, not in terms of, just in terms of analysis, the overall, and FIMDA also is providing something. But I'm saying these are all not, the source is not, it's all from market participants. It's not from a single place. Like, for example, the primary issuances of CPs and CDs we can get from the issuing and paying, office. So I feel that there is a need to have a real-time placement of primary market in the corporate bond market. In the secondary market, fortunately, there is a reporting system which is today available with the exchanges. And so all corporate bonds in the secondary markets have to be reported to the exchanges, and therefore one can get that information from the exchanges. The sixth factor that has also inhibited, I would say, the corporate bond market, and hopefully today it's different, is the enforcement of creditor rights. I think the enforcement of creditor rights would keep investors a little bit uncomfortable, because when there's no liquidity to exit, then ultimately you're caught. And then it's ultimately what is the resolution, what is the, in the event of default, what happens, what are your rights, how do you stand on par with other creditors. I think these issues are also a matter of significant concern. So these, I thought, are some of the important issues. I might have missed out some, but I know that we have some questions, and I'll be happy to address those if Aarti wants to take them. We'll take one mic each. Yeah? Hi, first time meeting you.
Yes. Thank you so much for going into all the details about what needs to be done to the corporate bond market to bring it on par with GCI.
I didn't talk about the governance issue. I'm assuming that.
Okay. Yeah. So from the mutual fund industry's point of view, even in the morning session, there was talk about how mutual funds have become quite popular with equity investors. And the industry is now gearing to actually position debt funds for retail investors. And looking at the AMFI data, actually I found that the money managed by the income funds, which are typically investors in corporate bonds, that's gone up from some 5 odd lakh crores to 7 odd lakh crores in the last 3 years or so. So given that you outlined so many imperfections of the corporate bond market, and the mutual fund industry mostly runs open-end funds, what is it that the industry has to really manage at the back end in order to actually deliver corporate bonds as an open-end fund structure to investors?
Yeah, I've been sort of toying with this ever since your question came and ever since Venkatesh asked me, because it's easy to say, okay, let's first deal with the role of the rating agencies. Because it is ultimately critically dependent on the rating, the frequency of their monitoring the rating, and the kind of information they are getting from the companies on a real-time basis. I remember in the last, corporate bond market seminar that I addressed, I had attended, I was told that rating companies are now getting, I'm sure there must be some people here from the rating companies, probably they'd like to clarify, that they really get some very real-time data from the companies that they are issuing ratings for. And therefore, they are in a position to even have the earliest smell of working capital problems or other early warning signals, which can, I don't know. I frankly don't know, but I think it's extremely important. I think it's extremely important for rating agencies, and therefore the regulator of the rating agencies, to be very aware of the fact that this is a corporate bond market where mostly privately placed, even though a lot of information may be available. Ultimately, I think fund houses have to monitor the companies also themselves.
So apart from the credit rating agencies' view, the fund house also has to...
I think so, because and that is why now you find that mostly it is only on AAA and AA that, the entire veering around of all these open-ended funds are going there. See, there are two risks. There is the interest rate risk and there is the credit risk. Yeah. And interest rate risk has hit all of those who invested in this market a couple of years ago. But interest rate risk is something you're consciously taking, and it's also manageable. I mean, I think mutual funds are allowed to use interest rate derivatives to really, I mean, if there are any issues in that, one can discuss them. But I think credit risk is something you can't hedge. And even if the CDS was launched and banks providing credit derivatives underwriting, that has not happened. It's going to be difficult because again, you're expecting banks to start underwriting credit risk, whereas the whole objective now is to de-risk the banking system and get it more into the retail. But I think these are really tough ones, and I think we have to be prepared for what I think the mutual industry, fund industry can do is to bring about much more transparency.
Right.
I think that will help a lot, and real time.
Is it also a function of having more participants in the market who actually follow MTM?
See, MTM following, I don't think really is a big issue for traders.
Okay.
Because that is your bread and butter. You have to do that. Yeah. I think the problem is, and it's not as if, when you look at the volatility in the bond markets, there is a certain element of predictability about it because it is linked to monetary policy cycles, it is linked to interest rate cycles, it is linked to global interest rate cycles as well. And some hedging, but then unless you do active hedging, it may become a very costly position. But I think we are seeing a lot of people now coming into hedging interest rate risk.
Right.
I think it's the credit risk that becomes the,
right.
The difficult one.
Okay.
And therefore you won't see too much of A, B, even though investment grade, mutual funds to get retail investors into papers where you're not very sure.
Yeah.
Those issues I think will continue to remain.
Right, right. Typically, retail investors are used to fixed income products where there is zero risk of capital loss. So as they come into debt mutual funds, both on the credit side, as you elaborated, and on the duration side, there could be a capital loss. And in fact, in the last 1 year, given the way rates have moved, it has been tough to actually manage good returns from long duration funds. So very recently only the industry has been exploring derivatives. So since you worked in this area, what are the ways in which they can use derivatives to hedge
Like against? I said, today, I would say even compared to 6 months ago, the derivatives market has really grown.
Okay.
I think it's also because banks are also using the derivatives market to hedge their ALM much more actively. Okay. And I think they did, all of them, get a rude shock towards the end of last year and earlier this year. So I think today, if you see the volumes in the OIS market and the IRS market, and there's a lot of transparency in this, and the FIBIL, like I said, has started putting out a benchmark on the OIS market as well. It is possible. Okay. It is possible to use it. And I think, just like we have all learned in the equity markets how to, I think here the fund managers will have to start actively doing it. Right. One thing is sure, you can't just sit on a position, just like in your trading. Even on a derivatives position, active management is what gives value. So I feel that is, interest rate risk will have to be managed. Right. And I think interest rate cycles in India are also shortening. It's not as long as it used to be. So we are getting into ups and downs a little earlier in the game. So, like I said, credit risk is something that hedging seems to me a very, very difficult.
Okay. Yeah. Okay, that's why there it has to be preventive. So the credit appraisal system.
Yeah, but still one wishes there were participants who would come into the CDS market, and offer credit default swaps and things like that.
Right. So, equity investors have many publicly available benchmarks, like you have the Sensex Nifty, which are in the public domain. But for debt investors, the benchmarks are still proprietary, and AMFI is offering a category average kind of a benchmark. But what are the constraints to actually building these benchmarks for corporate bonds particularly?
See, benchmarks can be either polled or traded. So what I could do is, I could call a couple of largest fund houses and say, what do you think is a typical corporate AAA benchmark? Not with a sovereign guarantee at the back of it, but a private benchmark. Would you all, just anybody would like to give a name?
Yeah.
Say HDFC. I'm just saying. Yeah. Now, supposing we say, okay, this is a benchmark. Now, then I have to see whether that bond, how frequently it has got traded in that last 1 month. Okay?
Right.
So that I am actually evaluating that particular ISIN number and finding out how much that bond is really moving.
Yeah.
And then I create a performance index. Over, it could be a spread over sovereign, and I use the spread to itself construct a performance index. But can I do that? Can I do that? And I think you have provoked me into thinking over the last 3 days on this subject and saying, how do we really do that?
Yeah.
Today, FIMDA gives out spread over G-SECs for a variety of different rating categories. But you know very well that even within a single rating category, it's very, very different.
Yeah.
For a same maturity, same rating, if you look at the trades in the market, the values and the yields will be very different. So then how am I going to really think, what is that benchmark?
Right.
That is, I would say, the challenge. And again, the only solution to that problem is, I'm not totally against polling. Polling, I found that when you don't have anything, then a polling works well. But the trouble with polling is that you have to be sure that there is no collusion and there's no fixing and all that kind of thing. So therefore, everybody is going on to traded benchmarks.
Right.
But if I go completely by traded benchmarks, I will not be able to construct a benchmark.
Because trading is imperfect.
Trading is imperfect.
Yeah.
And I need, based on a wide, unbiased sector of market participants, saying, okay, this is the benchmark and this is what, if I were to buy or sell, this is the yield I will quote, and then they have to be submitters. After all this LIBOR scam has happened, you don't get people to submit.
Right.
They won't even submit their opinion about what should be the yield or what should be the rate.
Right.
Because that becomes an object of then compliance and, penalties and this and that. So today we are really caught over there.
Yeah.
But still I feel it is possible, and that's what I requested FIMDA before came to do this, is why don't you publish a performance benchmark using just the in the AAA category. For the AAA category, you've got the spreads over G6 over the last so many months.
Yeah.
Use that and come out with some sort of an index. Because when I invest in a mutual fund today, all I'm saying is, what is your benchmark CRISIL bond index? That's what I get. Now, what is the CRISIL bond index? How is it composed? What is inside it? As an investor, do I know?
Yeah, that's the problem.
As a fund manager, you know. And as a fund manager, you do get it. But there is a certain, you see, people are trusting you. People are trusting you that your, valuation is okay and that your understanding of, that you are actually, and that benchmark actually reflects my risk preference. If you have a CRISIL bond index for AAA, then I'm assuming if I put my money in a AAA open-ended fund, then that I can actually use whatever you're giving me. And I don't get, I do invest in mutual, I don't get any performance benchmark returns. I only get what return you are reporting to me. I don't get any. How do I compare? Okay. With what do I compare? So I think this is something I would really think, as a result of this conference, you should do something about.
Yeah.
Strongly.
Thank you. Yeah. Just a last thing. There's a perception that whenever any savings instrument, like a mutual fund, becomes attractive in relation to bank deposits due to tax benefits or whatever, the policymakers always move to plug that loophole and then they level the playing field with bank deposits. But is this perception correct that they favor bank deposits?
I think we should ask banker that question. But suffice it to say that we should not have tax differentiation for a similar asset class. One can understand for a insurance or really pension,
right.
You have a tax benefit on a very long-term savings you cannot get out of. But if you are in the same category, a 3-year horizon in a bank or a 3-year horizon in a mutual fund, if I have a tax benefit in the mutual fund, then I would rather go and put money in the mutual fund. In fact, most of the bankers I meet saying that, no, we don't have any bank deposits, everything is in the mutual. the informed ones. So who is it who's putting money in the banking system? The massive number of savers, the small savers in the country, they are the ones who are putting their money in the bank deposits. So this is again, I don't think regulators really favor one section of this thing. I feel the tax distortions have been removed to a large extent, at least in the debt area. And still there could be this indexation issue still there.
Right.
In, if you retain your funds for that long.
Yeah. Thank you so much.
Thank you so much. Thank you.
Thank you. Thank you very much, Mrs. Usha, and thank you, Ms. Aarti.